The Value Turnaround, a comprehensive guide to Pfizer, PFE. As of March 18, 2026, Pfizer Inc., ticker PFE, represents one of the most debated value plays in the global pharmaceutical sector. After the historic highs of the pandemic era, Pfizer spent much of 2024 and 2025 navigating a difficult transition. The company had to right-size its operations as COVID-19 product revenues normalized and prepare for a series of significant patent expirations. However, entering the second quarter of 2026, the narrative is shifting from post-pandemic hangover to oncology powerhouse. Following the massive $43 billion acquisition of Seagen, Pfizer has effectively reinvented its pipeline. For an investor today, PFE is a bet on a high-yield turnaround story. This deep dive explores Pfizer's new focus on turbo-canceling cancer, its aggressive cost-cutting measures, and why its 5.5% dividend yield is currently the floor for its valuation. 1. The business model, from vaccines to biological missiles. Pfizer's business model in 2026 is defined by a radical shift in capital allocation. The company has moved away from its heavy reliance on primary care and vaccines toward high-margin, specialized oncology. The oncology revolution, the Seagen integration. The acquisition of Seagen is the cornerstone of Pfizer 2.0. Pfizer now owns a world-leading platform for antibody-drug conjugates, ADCs. The biological missile concept. ADCs are designed to target and kill cancer cells while sparing healthy tissue. In early 2026, drugs like Padcev and Adcetris are exceeding internal sales targets, contributing to an oncology segment that now accounts for roughly 40% of Pfizer's projected 2030 revenue. The pipeline depth. Pfizer currently has over 25 oncology programs in clinical development, focusing on breast, genital urinary, and hematologic cancers. The right-sized specialty portfolio. Beyond cancer, Pfizer maintains a dominant position in rare diseases and immunology. Vyndaqel. This treatment for cardiomyopathy remains a multi-billion-dollar blockbuster with steady growth in 2026. Velsipity, Pfizer's newer entry into the ulcerative colitis market, is gaining formulary traction, serving as a key pillar in the company's efforts to offset the upcoming patent loss of the blockbuster Eliquis later this decade. 2. The 2026 catalyst, the cost realignment harvest. The primary internal driver for PFE stock in early 2026 is the successful execution of its $4 billion cost realignment program. Efficiency as a strategy. In 2024, Pfizer faced criticism for its high spending during the pandemic wind-down. In response, management launched an aggressive restructuring. Margin expansion. In the most recent quarterly report, February 2026, Pfizer showed a significant expansion in operating margins. By centralizing its R&D and streamlining its global manufacturing footprint, the company has lowered its break-even point. The lean R&D engine. Pfizer has pivoted to a quality over quantity approach in its labs. Instead of chasing dozens of small indications, the company is doubling down on mega brands with the potential for $3 billion plus in annual peak sales. 3. Financial performance, the high-yield fortress. For many investors in 2026, the primary reason to hold PFE is the dividend. Key financial benchmarks, as of March 18, 2026. Current market price, approximately $29.85. Dividend yield, approximately 5.6% to 5.8%. Dividend safety. Pfizer has maintained a payout ratio that, while high, around 75% of adjusted earnings, is supported by the stabilizing cash flows from its new oncology launches. On May 1, 2026, the company is expected to pay its latest quarterly dividend of 0.42 cents per share. Valuation. Forward PE. Currently trading at roughly 10.5x to 11x 2026 earnings. This is a deep discount compared to the broader pharmaceutical sector, averaging 15x to 18x, suggesting that much of the patent cliff risk is already baked into the price. 4. Sector dynamics, the weight loss shadow. As your investment researcher, I must address the GLP-1 factor. In 2024 and 2025, Pfizer suffered because it lacked a competitive entry in the weight loss obesity market, while rivals Eli Lilly and Novo Nordisk soared. The 2026 obesity strategy. Pfizer hasn't given up on the $100 billion obesity market. Danuglipron. Pfizer is currently testing a once-daily oral version of its GLP-1 candidate. Initial data released in late 2025 showed a competitive safety profile. If the Phase 2b/3 data expected later in 2026 is positive, it could trigger a massive valuation re-rating for the stock, as it would give Pfizer a piece of the largest growth market in pharma. Combination therapies. Pfizer is also researching muscle-sparing weight loss treatments, aiming to differentiate itself from the first generation of injectable drugs. 5. Critical risks, what to monitor this month. Even with a 5.7% yield, an investment in PFE carries 3 specific risks that you must evaluate. The patent cliff wall. Between 2026 and 2030, Pfizer will lose exclusivity on several major drugs, including Eliquis and Vyndaqel. The company needs its newer launches, like the Seagen products and the RSV vaccine Abrysvo, to grow at an incredible rate to fill this $17 billion revenue hole. R&D productivity. The market still doubts Pfizer's ability to innovate internally. While the Seagen acquisition bought them a pipeline, the company must prove it can still discover new drugs in-house to justify a higher PE multiple. Litigation overhang. Like many big pharma firms, Pfizer faces ongoing product liability noise. While nothing on the scale of the Zantac or Talium litigations currently threatens the company, legal expenses remain a constant drag on the bottom line. 6. Strategy. How to position PFE today. In mid-March 2026, the consensus on Pfizer is a contrarian buy. The income and recovery strategy. The retirement anchor. Due to its nearly 6% yield, PFE is a favorite for income-focused accounts. At these price levels, you are getting paid to wait for the oncology turnaround to take full effect. The obesity optionality. Look at PFE as a high-yield value stock with a free lottery ticket attached to its oral weight loss pill. If the pill fails, you still have the 6% yield and the oncology growth. If the pill succeeds, the stock could easily trade back into the $40 range. Technical levels. The stock has established a multi-year floor at the $26 to $27 level. As long as it stays above this range, the technical setup suggests a basing pattern that usually precedes a long-term recovery. Conclusion. The oncology pivot. Pfizer, PFE, in 2026, is a company in the middle of a high-stakes evolution. It is no longer the COVID company. It is a massive industrial oncology firm with a world-class ADC platform and a disciplined cost structure. While it still faces significant patent hurdles later this decade, the current valuation and dividend yield provide a significant margin of safety for patient investors. The verdict. You aren't buying Pfizer for explosive immediate growth. You are buying it for the massive dividend and the long-term potential of its cancer-fighting arsenal. If you believe that the Seagen acquisition was the right move and that Pfizer can successfully navigate its upcoming patent losses, the current $29 price point represents one of the most attractive value entries in the healthcare sector.